Now, what are these parameters that you need to look at in debt funds? And we will go through each one of these in more details. But these are very important parameters that you must look at in debt fund research. If you're not looking at these parameters, then you would not be able to select the right fund for the right investment tenure, the right liquidity needs, and the right risk appetite. Most traditional fixed income investments provide 100% visibility into returns, right? So coming from that mindset, a fixed deposit or a government small savings schemes provide 100% visibility because they have guaranteed returns. So the debt fund investors wants a good amount of visibility in the screen. They cannot go into a fund completely uncertain about returns, actually. So next slide, Priya. Thank you. So what are the points to consider in debt fund? As we had discussed earlier, investment tenure. What is the anticipated liquidity need? So investor wants to invest for 3 years, but then you should ask him, is there a possibility that you may redeem after 6 months or 1 year? You need to ask that question. And, or there are other ways of figuring it out. If the investor has huge debt burden, then, you can make some educated guesses. What is the risk appetite? Based on these, then you need to decide whether you want to go for an accrual strategy or a duration strategy. What is the suitable duration profile? And we will go into these parameters, as we go through the article. What credit quality, funds that you may want to suggest for him. What would be a suitable fund category? There are a large number of fund categories in debt funds. And then, invest in multiple goals or build a debt fund portfolio for multiple goals. And so how you can go about building that portfolio for that investor. Next slide, Priya. So, in equity funds, we often look at, past returns, and a great deal of importance is given to past returns. It can be, trailing returns, 1 year, 3 year, 5 year. It can be, SIP returns, point-to-point returns, rolling returns, etc. Even the risk ratios, they're all based on alpha, beta, etc. They are all based on past returns. But debt funds, it is actually not possible to forecast short-term returns based on past returns. So we have shown you the category average returns from 2018 to 2023 annual returns for 4 debt fund categories. Now, by simply looking at these charts and looking at these figures, can you predict what 2024 return would be? It is almost impossible to predict because, as most of you know, debt fund returns depend on interest rate scenario. So if last year interest rate scenario was very adverse and this year it's favorable, doesn't matter what the return was last year. This year the returns would be different. So it depends on interest rate scenario and yields in the market, which is again then dependent on interest rate scenario. So that is why we are saying I am not suggesting that you don't look at past returns, but my suggestion would be that you look at other parameters that are more important for debt funds and also use past returns as an additional filter. So next slide, Priya. Now, what are these parameters that you need to look at in debt funds? And we will go through each one of these in more details. But these are very important parameters that you must look at in debt fund research. If you're not looking at these parameters, then you would not be able to select the right fund for the right investment tenure, the right liquidity needs, and the right risk appetite. So these parameters are: number 1, yield to maturity. Number 2, Macaulay duration, modified duration, maturity. These 3 are related concepts, but you must look at Macaulay duration or modified duration or maturity, especially modified duration or Macaulay duration for longer duration debt funds. By longer, I mean anything more than 1 year duration debt funds. Now, credit quality, again, is something you must look at. A few years back, we had some very adverse credit risk events, I think 2019 or 2020. So investors are now more aware, as we see based on feedback we get in Advisorkhoj or from our advisor clients. Concentration risk, again, very important in debt funds. See, debt funds, an equity fund would typically, a diversified equity fund like a flexi cap fund or a multi-cap fund would invest in at least 50 to 60 securities. Some may invest even in more, 70, 80. Debt funds, actually fixed income funds, invest in far lesser number of securities. So the concentration risk in debt funds is anyways high, but you should make sure that it is not very high. Concentration risk in debt funds. Obviously, there are some guidelines from SEBI, which mutual funds have to adhere to, which has now reduced concentration risk considerably for the benefit of investors. But still, this is one parameter that you need to look at. And then, you can look at obviously fund performance and, ranking, etc. And finally, there is SEBI has developed a matrix known as potential risk class matrix. We will go into it. This is a very useful grid that can help you get a sense of the risk of the fund. So now where to get this data? All this data is available in fund fact sheets actually. So you don't need to buy any subscription or any paid services for this. Everything is available in fund fact sheets. You can also find almost everything in research websites, including Advisorkhoj. And then, if you want some analytical reports, then you can go for subscription-based products. But this data is widely available everywhere. So next slide. So, one of the most important things that you would have heard in fixed income and, fund managers talk about it all the time is the yield curve. So now what is yield curve? And so, yield curve is very simple. Yield curve is, we plot yields of different government bonds, or it can be private sector bonds, say corporate bonds. But the idea is that, when the vertical axis is yield and the horizontal axis, the x-axis is maturity. So a bond maturing in 3 months would have an yield of say 6.75%. A bond maturing in 6 months would have an yield of 6.8%. A bond maturing in say 10 years would have an yield of around 7%, so on and so forth. So this is simply yield. So if you know your investment suppose you're investing for 3 years, you can, from this yield curve will give you a sense of yield. And remember, unlike equity, this is not very volatile. So, the yield may change by say 10 bips or 5 bips. In, extreme markets, maybe very volatile markets, 15 bips in a month, or it may not change at all in a month. So if you just simply look at the yield curve, it will give you a pretty good visibility into the interest rates and into potential returns actually based on yield. So I urge you to look at the yields. Where can you get these yields? One source great sources. Clearing Corporation of India Limited, CCIL. Go to their website. They provide the yields of government bonds. Now, we see some mutual funds like gilt funds invest in exclusively in government bonds, but there are other mutual funds, other debt funds which can invest in bonds of say private sector companies or PSUs, commercial paper, certificates of deposits, etc. So what would be the yield of say corporate bonds? The corporate bond yield would be the GSEC yield, which is shown in this chart, plus the credit spread. Now, credit spread would depend on the credit rating. So different bonds would have different credit rating from AAA, which is the highest rating, to C, or D, which is the lowest rating. So the spread would be lower for AAA and higher as you go down, AA, etc. Typically, I would say for AAA, you can add 0.35 to 0.5 on the GSEC yield. If you're investing in AA, you can add 1%. Or as you go down 1.5%, so on and so forth. So now you have a good sense of on any day you can have a good sense of yields actually. Now, how does yield translate into return? Because at the end of the day, the investor wants return. So the simple equation is price change plus yield is return for a bond. So now what is price change? So as you know that price of a bond or a fund depends upon the interest rate scenario. If interest rates are falling or anticipated to fall, price will go up. If interest rates rise or are expected to go up, then price will fall. So it is the inverse relationship. So right now prices are rising because we all expect that the interest rates will fall, or at least the central bank or the RBI is indicating that interest rates will fall. We don't know when, whether it will be September or December or January, but the market has already priced in that rates will be cut, and therefore the bond prices have gone up, and therefore the returns are higher. Now, by how much will the price change? Say, suppose if RBI cuts interest rate by 50 basis points in 2025, by how much will the bond price change? Because you need to know the price change to calculate the return. So that depends on a parameter known as duration. So duration, would be available on all websites. It is available in the fund fact sheet. So if RBI cuts rate by 0.5%, and if the duration is 2 years, we have shown it, the bond price change in yield into minus duration. So if RBI cuts yield, cuts interest rates by 1%, 0.5%, and duration is 2 years, bond price will go up by 1 year. So if the yield is say 8% and duration is 2 years, then 50 bips interest rate reduction, price change will be 1%, so your total return will be 9%. Now, this is at a bond level. At a fund level, you will have expense ratios, obviously. So now, how do you want to, if the investor wants higher return, what do you do? Very simple, go for higher duration. So now if you go for a 5-year duration, for a 50 bips rate cut, 50 bips into 5, that is 2.5% plus say 8% yield, return will be 10.5%. But having said that, remember one thing, that there is no free lunch. So the more returns means more risk. So risk and return are always related. So duration is directly related to interest rate risk. When interest rates rises at some point of time, interest rate is always a cycle. We call it the rate cycle. So interest rate rises, a fund with lower, a bond with higher duration will be more volatile. So it will fall more. So remember that, and advise your customers accordingly. So next slide. Yeah. So a lot of discussion is usually around interest rate risk, and you have to also worry about credit risk, of which less is talked about. So what is credit risk and what is the relationship with yield actually? So firstly, remember, AAA bond will give a lower yield or a lower interest rate than a AA bond. And a single A bond will give a higher interest rate than a AA bond. A triple B bond will give even higher interest rate. So if you take more credit risk, you'll get higher returns or higher yields. But as credit rating goes down, risk also goes up. So when we usually think about credit risk, we think of the worst case scenario, which is default. That the bond has defaulted, so it's not paying interest. But actually, the impact on the NAV of the fund will be much before default actually. Now, it is not always, credit risk is not always bad. So suppose the credit rating of a fund is triple B or say AA. Now a fund can go from, a bond can go from AA to AAA. It can get upgraded. If the credit rating gets upgraded, the price will increase. Plus a AA bond would have given higher returns, higher yield than a AAA bond. So one price increases, plus you're anyways getting a higher yield. So the returns will be high. But what if the rating gets downgraded? So a AAA bond, a AA bond gets downgraded to a single A or a triple B, then price will fall, and then your returns will be lower. So be aware of credit risk. I am not saying that, don't take credit risks. Be aware of it. And if the investor is not comfortable with credit risk, or if you are not comfortable with credit risk, then, you should avoid funds which have high credit risk. Next slide. Okay. So this is something that many of you would be familiar with. I would just spend maybe a few seconds on this slide. So this is known as the potential risk class matrix. Potential risk class means that, so what SEBI wants is, SEBI wants all the mutual funds to identify in which, they have 3 categories of interest rate risk, and they have the class 1, class 2, and class 3. As if you go for, so the interest rate increases as you go down this table. So class 1 has lowest interest rate risk, and class 3 has the highest interest rate risk. And then SEBI also wants them to map it on credit risk actually. And so the 3 risk categories are class A, class B, class C. And so as you go from left to right, the risk increases. So class A on the left has the lowest credit risk, and class C on the right has highest credit risk. So, and then for each scheme, the AMC would map or would indicate which box there are. So you can see there are 9 boxes. So moderate interest rate risk, moderate credit risk, high interest rate risk, high credit risk, or low credit risk, high interest rate risk, whichever box the scheme belongs to, and it is done at a scheme level, not at a category level. So you need to look at it at the scheme level, and whichever box the scheme belongs to, the AMC will indicate that. Now, this is a very useful matrix because you can get, the entire picture in one simple pictorial depiction.